What is going on, everyone? So I've got an important clip to show you today, but before I do, I hope that you smash that like button to share this with everybody that you know, with every single ape that you know. And I hope that if you're new here, you hit that subscribe button because I drop content just like this every single day. So Gary Gensler is getting his ass chewed, just torn apart by Congress because, you know what, he does not believe in PFOF and he wants to get it banned. But there's apparently some opposing views on the matter. So I want you guys to watch this. Let me know in the comments below what you think about this. Should PFOF be banned? If you don't know what PFOF is, it's payment for order flow. There's some other issues that come up, but you know what? I'm not going to keep sitting here talking about it. I'm going to let you guys watch and then tell me what you think in the comments below, and then we'll have a, friendly discussion about it. So let's do this. Check out this video.
Chair Gensler, it's your job to make sure that efficient markets are balanced with strong enforcement that protects Americans from the worst Wall Street greed and careless risk, even if that means challenging practices or shady investment products that previous chairs ignored. It means working to increase transparency that the last administration simply did not take seriously. We all know that in this committee. For example, the SEC approved new human capital disclosure last year without requiring companies to provide even basic details or data. Just give us some information, we almost disdainfully said. And let's remember, human capital is business school speak for the tens of millions of Americans who work for these companies. Despite the new standard, the investor demand for essential information used to judge how companies treat and manage these workers, most companies barely provide any additional information. My colleagues have been working to improve transparency. Senator Warner of Virginia introduced the Workforce Investment Disclosure Act to get companies to provide important information on how they pay and train and invest in their workers. His bill will shed light on how companies outsource and subcontract their workers, such an important part of our economy now, something he and I have jointly written to the GAO about. Today's tech companies like to say they're more efficient than companies of the past, when in reality they hire the same number of workers. Half of them are just invisible to us under today's disclosure requirements. Senator Warren of Massachusetts introduced the Climate Risk Disclosure Act, calling for significant new public disclosures from public companies regarding the risks climate change poses to their financial results and to their operations. These bills are good policy. The largest investors have been calling for more of this kind of information. I'm a co-sponsor of both bills. Of course, this would just be a start. Transparency is only a first step to getting corporations and the biggest investors to behave better. There's much more you already have the authority to do to make markets work better for the real economy outside of investment firm and hedge fund boardrooms. For too long, the financial system catered to the big guys, left everyone else on their own. Far too many stories of how insiders game the system. Big banks abuse customers while they make record profits. Brokers who've taken advantage of customers use the system to cover up and erase their misconduct. Private equity firms buy up companies and treat workers as a cost to be minimized. Workers as a cost to be minimized. Where have we heard that before? They buy up houses, they raise rent, they evict families even during a pandemic. And of course, no matter what happens to the workers at the companies they've raided for parts, or to the families in the mobile home complex where they've jacked up the rents, or to the larger economy, the big guys, the hedge funds, the SPAC sponsors, the big banks, the brokers, the big guys seem to do just fine. That system isn't sustainable. Increasing people's trust and faith in the market, in the financial system, will lead to more saving and broader participation. Yet some of my colleagues say we should let the market sort it out. They want to tie the SEC's and your and other watchdogs' hands. We know that's counterproductive. It's the same thinking that led to a market collapse 13 years ago that's led to decades of more and more investment flowing to a smaller and smaller share of the country. The last administration subscribed to that same always Wall Street first view and left this country worse off than they found it. The damage is too vast to measure. Our economy and our markets were no exception. Investors have fewer tools to hold management accountable. Savers, that's retirees, widows, families, have fewer protections. Corruption runs rampant, existing serious conflicts of interest have too often been ignored. This administration is taking a different view, thankfully. The economy and the market should work for everyone, not just the well-connected. They should reflect the economy we all want, with broadly shared prosperity and a growing middle class that all workers can join. When that happens, people will have confidence that markets actually work for them, not just for Wall Street. We'll see more Americans save. We'll see more Americans invest in the future. Chair Gensler, I look forward to hearing about the progress you're making toward these goals. Ranking Member Toomey, welcome.
Thank you, Mr. Chairman. Chair Gensler, welcome back. It is good to see you despite our significant disagreements. I do appreciate your dedication and enjoy working with you. As you know, the SEC has historically administered securities laws on a bipartisan basis generally. During your confirmation process, I expressed concerns that you might stray from this tradition and use the SEC to advance a liberal political agenda, such as combating global warming and advancing so-called social justice, and push the legal bounds of the SEC's authorities to pursue disclosures that are not financially material to the reporting company. Unfortunately, this appears to be exactly what you're doing. You've added mandatory disclosures on global warming and, quote, human capital, end quote, such as board and employee racial and gender identity to the SEC's agenda. You've essentially said that if large investment advisors and pension funds like BlackRock and CalPERS, who invest other people's money, if they want information about global warming or workforce diversity, it must be disclosed, even if it's financially insignificant and irrelevant to a particular business. Even President Obama's SEC chair, Mary Jo White, opposed using the SEC's disclosure powers for the purpose of, quote, exerting societal pressure on companies to change behavior rather than to disclose financial information that primarily informs investment decisions, end quote. That's exactly what you're doing. And you're well on your way to politicizing the PCAOB after firing all the existing board members. See, it's not the SEC's role nor its expertise as an independent financial regulator with zero democratic accountability to address these political and social issues. Similarly, I've worried that you would favor the paternalistic push by some on the left to restrict investor freedom under the guise of protection while actually harming retail investors. Such harm may result from your apparent opposition to payment for order flow, which helped allow brokers to offer commission-free trading. Payment for order flow allows a broker to keep a portion of the price improvement obtained by routing a transaction to a wholesaler. To my knowledge, the SEC has not demonstrated any failure or harm associated with payment for order flow, which the SEC has allowed for many years. Banning payment for order flow could very well have the effect of eliminating commission-free trading, which would be a grave disservice to average investors. And likewise, you've criticized mobile apps that make investing easy and fun as, quote, gamification, end quote. But in my view, delivering a product that customers like isn't a bad thing. And I worry that you're attempting to fix problems that don't exist today. Today is the best time ever to be a retail investor in the United States of America. Retail investors receive the best execution. A person of modest means can share in the gains of the stock market at negligible transaction costs. We see the tightest bid-offer spreads ever. At least 4 major developments for retail investors made this all possible. Commission-free trading, accounts with no minimum balances, low or no fee mutual funds and ETFs, and yes, user-friendly technology like mobile apps. And investors can even voluntarily use a broker who declines payment for order flow, but may therefore charge a commission. Now, despite decades of rapidly growing numbers of retail investors participating in stock market gains and enjoying more product opportunities at lower costs, some of my colleagues suggest that the markets are somehow rigged against retail investors. I'd like to hear how it is rigged. Don't retail investors receive dividends like institutional investors? Aren't retail investors entitled to best execution like institutional investors? Don't the value of retail investors' shares and those of institutional investors both increase when a stock price goes up? In my view, the SEC's job is not to make retail investing more expensive or unpleasant or difficult. In America, adults investing their own money should be free to decide how to do so. Let me turn to cryptocurrency, which together with the blockchain technologies, this is a very, very important and very promising new technology. As you know, Cryptocurrencies are actively traded on many platforms. A really important question is whether a cryptocurrency is a security for regulatory purposes under the Howey or some other test. Now, based on your public statements, it's pretty clear that you believe that some are securities, but others are not. So I'm frustrated by the lack of helpful SEC public guidance explaining how you make this distinction. What makes some of them securities while others are not securities? I understand that the SEC staff will privately provide feedback and analysis on whether a cryptocurrency is a security, but why is this analysis private? Why not publicly announce what characteristics make a cryptocurrency a security or not a security? In other words, how do you apply Howey and the Reeves tests to these new products? Why wait to make the SEC's views known only when it swoops in with an enforcement action, in some cases years after the product was launched? This is regulation by enforcement, and it's very objectionable. And I'm concerned it can stifle domestic innovation. So, Mr. Chairman, I hope we'll get a better understanding of your views on these and a number of other issues. There are many things on which you and I agree and where we could work together to protect investors, to ensure fair, orderly, efficient markets, and facilitate capital formation. I hope we can work together on these really important parts of the SEC's mission.
Thank you, Ranking Member Toomey. Today we'll hear Securities and Exchange Commission Chair Gary Gensler, no stranger to this committee. This is Chair Gensler's first appearance here in this role. Chair Gensler, please proceed.
Good morning, Chairman Brown, Ranking Member Toomey, and members of the committee. I'm honored to appear here before you today for the first time, as you said, as Chair of the Securities and Exchange Commission. And I'd like to thank you all for your support in my confirmation this spring. I'd also note, I think, Chairman, you may be the 8th chairman that I've appeared before in this committee. I'm aging myself a little bit, but I think Chair D'Amato might have been the first that I was in this committee room. As is customary, I should note that my views are my own. I'm not speaking on behalf of my fellow commissioners or the staff. The U.S., as Ranking Member Toomey said, the U.S. is blessed with the largest, most sophisticated, and most innovative capital markets in the world. We actually represent 38% of the world's capital market, and that's when we're only about 23% of the world's economy. They're competitive, they're efficient, they're transparent. But I think we can't take our remarkable capital markets for granted. New technologies continue to change the face of finance for investors and businesses, and more retail investors than ever are accessing our markets. Our countries and other countries are also developing deep competitive capital markets as well. And though I provide greater detail in the written testimony, I'd just like to flag 3 areas for now. First is market structure. Market structure is fundamental to our mission to protect investors. On the other side, facilitate capital formation, and that which is in the middle, fair, orderly, and efficient markets. How do we do that? It's through transparency and competition in those markets. So I've asked staff to take a look at a number of market structures. The Treasury market, that's the base of all other fixed income markets. The non-Treasury fixed income markets, corporate bonds and municipals, which, by the way, in the U.S. are twice to 2.5 times the lending out of banks, are loaned through our capital markets, our equity markets, and securities-based swaps as well. In each of these crucial markets, I think companies and investors alike benefit if we can increase competition, lower costs, and bring more transactions out of the dark. Second is a rapid change in technology. We're living in a transformational time, perhaps as transformational as the internet itself. Now, I expect some members might ask a question or two about crypto, but actually the first thing I just want to mention is artificial intelligence. AI, predictive data analytics, machine learning are shaping and will continue to shape many parts of our economy. And while these developments, I believe, can increase access, increase choice, and lower costs, they also raise new questions about potential conflicts, biases in the data, and yes, even systemic risk. And now for the crypto, because I know that you're all, keenly interested. We just don't have, I believe, enough investor protection in crypto finance, the issuance of these tokens, the trading, and particularly the lending. Frankly, as I've said before, I think it's more like the Wild West. I've asked the SEC staff, working with our fellow regulators, the Commodity Futures Trading Commission, the bank regulators, the Treasury as well, using our current authorities, how can we best bring investor protection to these markets? I stand willing also to work with this committee and other committees of Congress if you take up any legislative initiatives. And then third, issuer disclosure. You see, since the 1930s, we've had a basic bargain. Investors get to decide what risks they take. That's up to investors. But Congress said that it should be based on full and fair disclosure of the issuers. Over the decades, we've updated what those disclosures are. And today's investors are increasingly looking for consistent, comparable, and decision-useful disclosures around climate risk, so-called human capital, cybersecurity, and other areas. So I've asked staff to develop proposals for the commission to consider these potential disclosures. And yes, put these proposals out to public comment, put rigorous economic analysis against them, and what is it that investors want to see, and have the public comment. Beyond these policy areas, the SEC employees oversee 28,000 registered entities, more than 3,700 broker-dealers, 24 national security exchanges. You've got the picture. A lot going on in our capital markets, $110 trillion capital markets. Last month, we authorized voluntary return to work, but we've been largely remote for 18 months now. This speaks to the dedication of the SEC staff. I cannot compliment them enough. And while capital markets have grown, the SEC has not grown to meet the needs of the 2020s, though. Over 5 years ago, we were about 4 or 5% bigger. And so I just think that it'd be helpful to be a little bit wise and add to our staff. I hope that you can agree with me on that. Thank you. I look forward to your questions.
Thank you, Chair Gensler. How a company, as we've discussed privately and you've spoken publicly, how a company treats its employees matter. The SEC can require companies to disclose that information, but instead of crafting a rule that would provide information and data that could give real insight, the last SEC chair wrote a vague rule that companies can interpret to require as much or more often as little information as they like. That lets companies say they pay their workers a living wage with ample paid leave and retirement contributions while subtracting out half their workforce to subcontracting out half their workforce to companies that pay lower wages with stingy benefits. We know that's a business model for many companies. Now, why is it important to have disclosure standards that are consistent and comparable across companies?
I think that investing in a company, the human capital, the workforce, is a key asset. I remember when I started on Wall Street at Goldman Sachs, and we used to sell companies. And when we sold companies, we'd always have a section in that private offering memo about the employees, what they're paid, how many are part-time, how many are full-time, where they're located, retention, and the like. It's even more important in the 2020s than I was young on Wall Street because it is so critical to the valuations of the company. Now, again, we'll put this out to, if my fellow commissioners concur, we'll put it out to public comment and see what investors have to say. And then their feedback is going to guide us on any final rulemaking.
I think it's pretty clear investors are going to want more information like you suggest in your Goldman days. We've talked before about how Wall Street has treated the markets as a game for decades, a game they always seem to win at the expense of pretty much everyone else, including communities in Wyoming and Louisiana and Rhode Island and Ohio and Pennsylvania. SPACs, for instance, draw in companies that want to please Wall Street, sometimes make promises that they can't deliver on. Look at Youngstown, Ohio. There's a lot to unpack with what's happening at Lordstown Motors, whether or not the company's ultimately able to succeed. And I hope it does. It seems clear there were outside investors looking at this not as a long-term investment in a community with a proud manufacturing heritage and a talented workforce, but as a way to make a quick buck with no follow-through. There will always be people, of course, like that, but that doesn't mean we need to encourage risky financial mechanisms to encourage speculation over long-term investment. In a situation like that, when those investors make their money and pull out, companies break promises and workers and community pay the price. What are the risks, Chair Gensler, what are the risks that the SPAC market has highlighted over the last year, and what can we do about it?
I think the special purpose acquisition companies, these blank check companies, the risk are to investors and the disclosure to the investors. I've asked staff to serve up recommendations that we could consider as a commission. But in essence, there's a lot of costs in these. And secondly, they usually have a 2-year fuse. And in that 2-year fuse, they try to go out and buy something. And a lot of the institutional investors, when that happens, sell. It's called a redemption right.